Look, it's official. Major combat operations have now begun between the United States and Iran. In my last video, I explained how oil, gold, and silver were moving together at the same time. Hard assets rising in lockstep during rising geopolitical tension. Markets were already pricing risk before the headlines arrived. That was yesterday. Today, the situation has escalated into reality. Here's what unfolded while much of the world was asleep. Reports confirmed coordinated airstrikes targeting key locations. Statements from US leadership made it clear this operation is not limited or symbolic. Officials openly acknowledged the possibility of casualties and described the objective as severely damaging Iran's military capabilities. Shortly after the strikes, Iran responded. Ballistic missiles were launched toward US military installations across multiple Middle Eastern countries. At the same time, retaliatory actions were directed toward Israel. Several Gulf nations immediately shut down portions of their airspace. Officials confirmed these operations are expected to continue for days, possibly weeks, not hours. Iran's leadership publicly confirmed that senior officials survived the initial strikes while also declaring that previous limits on retaliation no longer apply. Meanwhile, regional militant groups announced renewed attacks on shipping routes, particularly around the Red Sea. Almost immediately, major oil companies began suspending shipments moving through the Strait of Hormuz, one of the most critical energy choke points in the world. When shipping risk rises there, global markets pay attention instantly. So now people are waking up to several simultaneous developments. Large-scale combat operations underway, direct strikes tied to leadership targets, retaliatory missile launches across multiple countries, continued military escalation, and openly stated regime-level objectives from opposing sides. Moments like this are rare. There are long periods when nothing major happens, and then there are weeks where history accelerates rapidly. Whether this becomes one of those defining moments is still uncertain, but markets are already reacting as if risk has fundamentally changed. Now let's talk about what prices did overnight, because markets never wait for confirmation. Gold surged aggressively in markets that remained open while Western exchanges were closed. Tokenized physical gold trading channels spiked sharply, briefly approaching record territory before stabilizing slightly lower. Physical gold pricing in Asian markets traded hundreds of dollars above Western paper prices, creating one of the widest premiums seen in recent months. That premium matters. It shows real buyers demanding actual metal delivery rather than paper exposure. When physical markets separate from futures pricing, it signals stress inside the system. Most global portfolios still hold only a tiny allocation to gold, roughly 1 to 2%. Yet physical buyers in major Asian markets were paying massive premiums during active geopolitical escalation. That disconnect tells you institutional positioning may still be behind the move. In Southeast Asia, at least one major gold dealer temporarily halted trading due to extreme volatility. When dealers stop operations because pricing becomes unstable, it means supply and demand are moving faster than traditional systems can handle. Silver followed the same pattern. Physical pricing in Eastern markets traded significantly above Western futures prices, expanding an already existing premium gap. The difference between physical demand and paper valuation widened during the exact moment geopolitical risk turned real. At the same time, Bitcoin and broader crypto markets dropped sharply following the strike news. Large leverage positions were liquidated within minutes. While digital assets sold off under pressure, physical gold moved higher. That contrast shows how markets behave when uncertainty suddenly becomes tangible. Yesterday's market structure already hinted at this possibility. Oil was rising. Precious metals were climbing together. Capital was quietly moving toward hard assets. Those movements suggested informed money was hedging against outcomes many people were not yet discussing publicly. And now the headlines have caught up with the positioning. Looking specifically at silver markets, several structural signals were already flashing before the escalation began. Futures open interest had been falling, even as prices climbed, a sign that weaker speculative positioning was leaving while stronger holders remained. Lease rates were rising consistently, indicating tighter availability for borrowing physical metal. When lease rates rise alongside widening premiums and declining futures participation, it often reflects declining confidence in paper settlement systems. Industrial buyers were reportedly offering unusually high prices to secure guaranteed silver supply. That type of behavior typically appears when delivery certainty becomes more valuable than price itself. History shows that successful market participants rarely wait for perfect confirmation. They study structure, liquidity flows, and positioning shifts before events become obvious. Markets constantly transmit signals, but only to those paying attention early enough. What connects everything happening right now is the convergence of multiple forces at once. Military escalation increasing safe haven demand, shipping risks threatening energy supply, currency uncertainty encouraging diversification, and ongoing central bank accumulation reinforcing long-term precious metals demand. All four drivers are activating simultaneously. Of course, there's always a counter-argument. Markets could open with large gaps and then retrace. Diplomatic pressure could slow escalation. Shipping routes might stabilize faster than expected. Paper markets have historically pushed prices lower after initial geopolitical spikes. But the difference this time is duration risk. Officials are already signaling extended operations. Retaliation has crossed multiple borders. Airspace closures and shipping disruptions are real, not theoretical. Price discovery is already happening in markets that never closed. Physical gold trading levels overnight gave an early preview of where traders believe fair value currently sits, under elevated risk conditions. When Western futures markets reopen, gaps are likely. The key question will not simply be how high prices open, but whether those levels hold once liquidity fully returns. Because beneath the headlines lies a deeper issue. Physical supply stress has been building for months. Precious metals have recorded persistent strength, inventories have tightened, industrial demand remains firm, and central banks continue accumulating reserves. Structural pressures do not disappear overnight. Financial history shows that systems can appear stable for long periods while underlying imbalances quietly grow. Then adjustment happens suddenly rather than gradually. Right now, markets are entering a period where geopolitical conflict, monetary uncertainty, and supply constraints intersect at the same time. Over the next 48 hours, several things will matter most. The scale and duration of military operations, whether retaliation expands further. The stability of critical oil shipping routes, how large the market gaps are when trading resumes, and whether physical premiums continue widening or begin compressing. Verify information carefully. Follow multiple sources. Watch price behavior rather than emotional reactions. Situations like this create volatility in both directions. Prices can surge, pull back, or move unpredictably in the short term. But real-world supply and demand ultimately determine long-term outcomes. This isn't hype. It's understanding how markets react when uncertainty collides with reality. Stay focused on data, positioning, and risk, not noise.